Here we go. Gabriela, good morning.
Good morning.
How you doing today?
Great.
It's good to hear. It's good to hear. So this is the monthly mortgage market update with myself, Jon Johnson, and Gabriela, Cernas-Frantz. This is our first episode doing this. The main goal of this is to be able to help educate people on what's happening in the industry right now, to get people more up to date. But even more important than that, the most important reason for my business and everything I'm trying to do is to help people gain debt-free through home ownership. So it's not just about buying a home. I mean, buying a home is great. You're able to have a place for your family. You can change your walls up, coloring. You can make additions. You can pass on generational wealth. There's a lot of great things. But if I can be able to take somebody from having debt, renting, or owning a home and having debt, things of that nature, and get them to a point of being debt free, that's my main goal. So that's a lofty goal, but there's a lot of people out there need assistance. So good. Let's go ahead and go. Before we get started, Gabriela,
Yes.
tell me something that has been on your mind in this industry recently.
A lot of it has to do with the first-time home buyers and their lack of education and not understanding the process, and then sometimes getting caught in the middle of what could be resolved very easily, but then all of a sudden you have different parties that they're working with. They're working with their realtors. The realtors are working with the listing agents. And then you have us as the lenders that are coming in. And I think that overwhelms a lot of buyers. And also what's being put out on the news. That's a big factor that drives a lot of people when they're hearing different things coming from the Fed rates, what's going on in the economy, inflation. So that's a lot of what we've been hearing lately.
Understood. I'll say I agree with you what you're saying. This is a business where there's a lot of information coming at people about it, knowledge, in order to be able to understand it.
Agreed.
I mean, the average age of your loan originator is about 45 to 50 years old. And that's not because there's not young folks trying to come into the business to try and, be able to help assist, but the amount of knowledge and information you need to be able to guide a buyer from initial qualification through pre-approval, through conditional approval, through finding a home, through going into contract, processing underwriting, finally closing, and then even after closing, there's a lot of knowledge that to go into that. And your average person that's talking about this stuff on the news, your average person that's talking about this stuff, writes a random Google blog, it's a lot of misinformation. So I agree with you on that. I'll tell you one thing that's been on my mind lately. I'm a huge fan of trying to find affordable housing for people. We're in the Tampa Bay area. Very hot market. You are correct. It was already at a point to where when I first moved to this area probably 5-6 years ago, people that rent, it was a little bit higher for them, trying to get into a mortgage, but it's at the point now to where it's really pricing out a lot of first-time buyers.
It is very difficult. It's very challenging having out of state, people coming into the state of Florida. I mean, the appeal is always there. There's a lot of benefits to living in Florida, but affordable housing is a big concern. We're talking about the Tampa Bay area where we live in every single day, and we're hearing about people having difficulties finding even rent. Price increase in rent. Some have even said it's gone up 20-30% in rent costs, and what would have been normally like a 5%, maybe even a 10% increase, it's not. Now it's triple that. And so even people that are living, working, and supporting their local economy are getting priced out.
You are correct. It's almost getting to the point now to where, I can't fully tell buyers this all the time, but I definitely think it is certain buyers I'll mention it to them. But living in a city is a luxury. Like living in the middle of a city, especially in Tampa Bay area, either renting or definitely buying a home in the middle of the city, that's a luxury. And so people that are up in the Northeast, they've owned 1 to 2 homes. They worked at their jobs for 20-30 years, and now they're buying homes out here in this area. And it's not just here; it's happening all over the state of Florida and many others as well. But it's a situation to where first-time buyers, especially, not being so caught up on I want to live in this area, but have the flexibility of where you want to live. Even employment. I mean, in this job, we don't just say, hey, this is how you get into a home. Like when I'm inviting buyers, I'm looking at, how to get them into a home. I'm looking at their credit situation. I'm looking at their income situation, their debts. I'm looking at all those different types of things. And even advising buyers like, hey, if you can make the same amount of money with the job, but you're able to work remote, that frees up your potential and ability to buy a home so much more than if you have to work at that one specific job where you now, if you want to buy a home, it may be an hour, hour and a half away because it's outside the city.
Commuting, and we're talking about gas, because everybody has that on their mind right now, is gas prices. And these are things that, at some point will pass. We don't know when, but they will pass. But for the people living, working here, it can become expensive just commuting alone.
Yes.
And that's also, that has to be factored into their cost of living as well. It's like how much of their income is going towards housing, gas, travel. The luxury of living in a city is that you get around pretty easily, but a lot of people drive in the city.
Yeah.
Public transportation isn't, really big in the Tampa market. It may get better. I'm hearing that there is some work in the city of Tampa that they're trying to improve more transportation.
Yeah.
But those are outside factors that that don't always affect a person coming and living.
You got it. You got it. So I mean, we can get to a point where hopefully we can get buyers. I mean, I mentioned manufactured housing, something that's more affordable for buyers, something that hopefully builders can do cheaply, can be affordable for buyers, and these new manufactured homes are pretty nice as well. But good. Let's see what we have on the agenda today. So we'll begin with rates, because we talk to mortgage professionals, they always want to, hear what's happening with rates. So in general, historically, rates are still decently low from a historical standpoint. But there's a lot of recency bias when it comes to rates, because a lot of people talk to their friends, and their friends say, hey, I bought a home or a refinance a couple months ago and I got, this low rate. I got a 2.8 rate or whatever rate. And now, they try to come in, they start trying to buy a home refinance, and now it's stating, hey, rates around 4.1, 4.3. And you can get the low, a lot of times you have to pay higher closing right now. So what's your rate market is?
Well, from the working in the office standpoint, we're getting more calls in now because, I believe that sometimes people were waiting for this hypothetical that everything was going to stay fine, that the rates weren't going to fluctuate. But there's also external factors, not just in the state, nationally, internationally, that have now pushed this.
Yes.
And when people compare, last year we were in a whole different, state. We were in a whole different, we were still dealing with some COVID, guidelines and lockdowns, and that was slowly getting pushed out. And also, the government was trying to make it easier for people to get into homes by offering them a stimulus package. There's a lot of things that happened last year, and now, with the recent announcement of Fed rates, we were telling consumers, don't think that this is going to last. I mean, we were telling buyers, these 2%, 3% interest rates, you gotta buy now if you're going to make that decision. And the people that said, no, I'll wait until things, I don't know what things they were waiting for, but everybody has a reason for waiting to buy a home. Maybe in this case, it might have been their credit wasn't great, they didn't have enough assets. But now we're here today, and it's a whole different story. We're talking 4% rates, and I think people get upset when they didn't make that decision earlier.
Yeah, people overthink this process a lot. And by the way, just to say, I'm a mortgage loan originator, so I help buyers, from start to finish, to be able to get into a home and then refinance and things after it. Gabriela next to me, she's on our team as well, and she's wonderful. She deals with marketing, a lot of admin. She's really kind of like that service side when it comes to the buyers and agents, all those different types of things. So just to let you know what we kind of do in the business. But yeah, I would say this with the whole rate game. Many buyers, they overthink, home buying, they overthink refinancing, and it's not, it's tough in the market when it comes to trying to find a home, but at least from the mortgage side, don't overthink that part of the process. It's pretty much, it is what it is. If rates end up going up 0.5, 0.75%, don't get too crazy over it, because, like I said, my main goal is to take somebody to be debt free with home ownership. If you're at the end stage, meaning that you're debt free, you own a home, and you can absorb a higher monthly payment, and you're trying to look towards a 15-year mortgage, which is the best way to be able to gain the most equity in your home in the quickest way possible, then yeah, rate may play a difference because you're looking to try to find a mortgage that you may have for the next 10 to 15 years when you're trying to pay this thing off. And the difference of, 0.75 or 1 percentage point rate, that could play some sort of difference. But in the grand scheme of things, when you talk about the entire interest over the life of the loan, going from a 3.5 rate to a 4.25 rate on a 300K home, that can end up being a difference of 10, 15K in interest over the life of the loan. While taking that same deal from a 30-year to a 15-year or a 20-year is going to save you 80, 90K over the life of the loan. So the rate is not the most important thing. A lot of buyers get really caught up on that. More important is to get to, in my opinion, get to the point where you're debt free, because other debts, like, when you have credit cards, when you have installment loans, car loans, if you get debt free of these things, that could be over $1,000 a month that you're saving, to where, hey, if you have a higher interest rate, 0.5% higher, you may be paying, $30 a month, $40 a month more on that mortgage, but in the you're saving so much more on being debt free, and then eventually when that 15, 20 years.
I think that's actually a great point that you're making, is that when we're talking to clients and they're refinancing, it's like what their purpose is for that refinancing. If they're looking to, get out of debt, those are, as you're saying, those are less payments that they have to make monthly, but they're just shifting it over to their home at an interest rate that is, we're saying 4.25 right now, right? As opposed to what a typical auto loan interest rate, credit card interest rate, and those are ongoing. While a car maybe has 5 years, 3 years, 7 years, that's a short term. And then when we're talking about credit cards, those can go on for years.
Yes.
And that's accumulating interest in it. You're paying every single month, every single time. So when you refinance, you can knock out some of those debts, but you're going to absorb them into a refinance at a lower rate. Am I correct in saying that?
You were correct in saying that. Okay. And I'll say this is much smoother and easier mentally to be paying that one debt than to be having to go through 10 different things in the mail or 10 different items, being auto paid and going all these different places. Mentally, if anyone follows the Dave Ramsey system, we recommend not the system that he proposes works. It's never not worked. He probably didn't invent it. He probably got it from someone else. He passed it down from someone else. But the whole system is get rid of the small debt and get to the point where you only have a big debt, and that's the main thing you're trying to knock out. That's in his baby steps. Further down the line, he has other things you can be able to do as well. But when it comes to just generic financial freedom, it's working your way to be debt free from getting the small stuff paid off. You only got one big thing to pay off, and then once that one big thing is paid off, you're financially free. But good. We'll let you skip a couple. So good. Mortgage applications. Mortgage purchase applications were higher last month, which makes sense. This is getting into a busy time of the year for mortgage. Refinance applications are down. Rate and term, which means you're just refinancing to go from 30 to 15 or 20, or you just refinancing to get a lower rate, or get mortgage insurance off. That's down about 30%. Cash out refinances, which is you getting cash out to be able to pay off debts, home improvement, things of that nature, down 15%. What do you think about these?
Well, it makes sense. From the numbers that we're seeing just in our office alone, but we are still getting a very mixed. It's a mix between purchases and also a mix with refinances in the office. So conversation as to why the buyer is seeking to refinance. We hear from conversations that we have in the office, from the loan officers when we're talking about, very specific clients and stuff. But I think that right now there is a caution that buyers are having, and they're worried. People who don't know what's to come sometimes will stay in place and keep waiting. And that's what we kind of bring back to what happened even last year when the rates were even better, is that people were still waiting for something better.
They're always waiting, overthinking.
Always waiting, overthinking, and that's a mindset. And that has a lot of factors to do with what their current situation is at home. But at the same time, pointing out the benefits of a refinance and a cash out refinance. That's really where it takes somebody to either motivate or inspire or get that buyer to really see the big picture, which is what we kind of do in the sense, is we kind of take a bigger picture when we go through the loan process with them. But it's the external factors of people that are around their circle, their sphere of influence, that is holding them back.
Yeah, sometimes it could be that way, where the spirit of influence is holding back. There's a lot of buyers nowadays that are just into their phones, into whatever the news is on, and they get paralyzed, by, I may need some more information. When the main game is trust. If you know if you know how to make the home process work for you, you know how to control it, you don't have to worry. You do what you got to do, you take care of business, and you're good to go. A majority of people, even people that are very, that come from deep families that are even in the business, it's tough to be able to just know how all of this stuff works. So having that real estate agent person on your side before you buy and even after you buy, having that real estate agent you can go to for any questions, and having that mortgage person you can go to for any on the member side, and then trusting that person is very important, because looking at those numbers, cash out should never be done in my opinion. Cash out should only be increasing, because the great thing about a mortgage cash out is that you don't take out all of the equity. So if a home is worth $400K, the most you can take out is up to you have to keep at least 20% equity in the property. So let's say if it's supposed to be appraised or it's valued around $400K, that means that $320K is what your real appraised value is. That's the most you can go up to. So if you have $250K left on a loan, that's $70K of equity you can be able to play with when it comes to your home. And so we don't want to do what people were doing in 2004, 2005. And I don't hear anybody advising about this, where people are pulling out cash out to buy boats and toys and things of that nature. But pulling out cash to be able to pay off bills and debts and things of that nature, or if something foundationally is going wrong with the property, regardless of the interest rate, those types of things are going to always be worth it for you, in my opinion, especially from the debt solution. If interest rates go up, your monthly payments go up on your mortgage by $200 a month because you did a cash out refinance, but you were able to save $1,000 in monthly payments for your debts. That's still a net $800 for you. But purchase applications are higher this month as well, and it makes sense because when it comes to purchase applications, people don't put too many homes on the market in November, December, and then as soon as it flips over to January, February, March, there's not too many holidays. People travel a little bit, but it's not a heavy travel time. So when people are thinking about selling their homes, many times it's from this time up until about summertime.
And even when we talk about the normal real estate and the normal trends that we're seeing, it all kind of falls in line. Holidays. People are like, I don't want people coming into my home. It's very hectic. For sellers at that time as well. And also, depending on the demographic of the consumer as well. Families, for example, they have to worry about their kids. And so that's why summertime tends to be a bit of an uptick, because that's usually when it's good to make a change in the household for moving. Obviously, there's external factors if the person has to move because of a job, a family situation that, they have to move closer to take care of a relative. I mean, we've heard every kind of reason why people are buying and selling at a very specific time, but when people plan things out, it's kind of normally what we see is when they start looking to put their property up in the market. Even outside of the external factors in the normal real estate market, that tends to be the big wave that we go through.
You were correct.
We may still see some of that, but maybe at a different with different levels, as opposed to what we've seen, in the past before. Because really, the past 2 years have been a complete anomaly if we're looking at it from a 10-year perspective.
Yeah, it's been an anomaly, but it's almost getting to the point now to where we only got to say this is like the new norm.
This is a new normal.
Because we're not seeing numbers change when it comes to how many buyers are putting offers in on properties. So it almost seems, a couple months, 6 months, a year, you're like, hey, it's got to change at some point, right? You get to a year and a half, still hasn't changed. 2 years, still hasn't really changed. It's almost as if this is the new norm, so people get used to it. And if you're, obsessed like I am about trying to find affordable housing, maybe getting more towards mobile homes, things of that nature, and outside locations, could be more beneficial for people.
Yeah, and as you're talking about like the new normal, I think that's also what we deal with with individuals in their thought process. They're wanting to go back to that was predictable, somewhat safe, and we're just not going to have that right now. So when it comes back to what you said earlier, it's about trust. Who do they trust with their finances, and also to say, look, this is my financial situation. This is where I'm at. Is a refi a good benefit for me at this time? Some people could be using it to set up for long term for children's education. But the new normal also means that there's still the same concerns, but it's just how do we navigate through this new normal? And there is a lot of information that's coming at consumers.
A lot. And my main thing is, as soon as you get a ton of information, no matter what field you're in, find that person you can always go to, whether it's in the mortgage space, the mortgage person, real estate, doctor information, all this COVID stuff. Find that one doctor that you love and appreciate. Go to that person. Like, you can't use 50 different sources. You got to have that one person you depend upon to give you answers. All right, let's see what else we got. Mortgage and real estate tech bubble. One company, I'm not going to mention the name of the company, where there's a lot of mortgage companies over the last couple of years that have gone public to try to raise funds, and just because it's a hot time to be able to get funding, especially for upstarts right now. There's a lot of people trying to become new and up and coming. They're trying to shape the mortgage business. And to be honest with you, there's a lot of money in this business. There's a lot of people that want to invest in this business. So seeing that you have a new product that's going to shake up the mortgage and real estate industry, gets a lot of eyes and ears on it from the investment space. But yeah, one company raised $70 million in capital, went into $150 million in debt over the past couple of years, and even had a public offering recently where they raised $200 million in that public offering. But that same company laid off 46% of their workforce because they stated they did not raise enough money that they were hoping to raise. I've already mentioned so much in this conversation so far about how much I care about being debt free, and businesses taking out almost 50%. And they're trying to leverage, but having to then lay off 46% of your workforce, and this wasn't a small company, this is a big company. Not a giant, but a bigger upstart. But Gabriela, what do you get from this?
This is on a larger scale because we're talking about a lot of money here. But this isn't something new. I need to say it. Like, this isn't a new practice when it comes to businesses. How this is where it gets a little sensitive because when we from our loan loan perspective, when we're pre-qualification and the pre-approval process for consumer, for a client, future home buyer, and we can call them many different things. When they are laid off, that is just an immediate dent and impact into their income. And as whether they're alone or whether they have a family, this is the kind of stuff that when you see where companies are prioritizing, are they investing in their employees, their workforce? Because the economy can't survive without the workforce. It needs the workforce. It needs consumers. It needs people to buy and sell within their own economies, local economies. And so when I hear companies doing this and laying off 40, my big number that I'm looking at is the 46%. That is 46% of this company, whether they had 100 people, whether they had 1,000 people, that are now unemployed in a new economy that we're looking at. Because if we're looking at a new normal, this is also a newer economy that people are entering into the workforce. We see job number reports, unemployment numbers. Unemployment is going down a little bit, and new jobs created have increased. But there are individuals who unfortunately just don't want to go back into the job market after this. And that can have a severe impact in their financial future. Sure.
Thank you for adding that human element, by the way. Because when I read about this, I didn't even think about it from that human type of element. I was thinking about it from, which that's great to hear because that's good to hear.
It's a different perspective,
It's a necessary perspective.
Because when you talk about the human element of, 46% of people here lost their jobs in an industry that they thought that they were going to be in for quite a long time, and believe that a company brought up in raised $70 million in capital and then had a public offering and brought in $200 million more, and then that they still laid off individuals. That impacts the consumer, that impacts our potential future clients at that time. So
I would say this. My perspective is buyers out there, you go on Google and start going down that rabbit hole of researching things, you're going to see a lot of information that sounds new and shiny. In my opinion, try to stay away from the new and shiny. Always have that mortgage person that you know and trust in your back pocket, and trust them and go off their information, because these companies, they come in during hot times when the market's doing good, things of that nature. And as soon as things are getting weird, a recession happens, the market's not as good, they're the first ones to be able to leave.
Yeah, and that has a lot to do with, new leadership. A new company, brings in different talent that's supposed to come in and give them an analysis and perspective of, this is a good investment, this is going to start, because there have been successful companies that have come in when, the economy hasn't been, at its best, and have done extremely well. Some of those bigger company names are still making, millions and billions of dollars right now. But from the other side of things too, is that, companies, and this is more to say about, maybe like specifically the DFI, because I can only speak on that, is it's the tenure of the leadership, it's the stability of the company over time. And, when you have a new company coming in, there's going to be some great things that they're going to come out. They might come out with new technology, maybe a new way of marketing and reaching out to the consumers. And those are the things that are in the consumer space all the time, when they're picking up their phone, when they're on the computer, when they're, on whatever social media outlet they decide to get their information or interact with individuals. Like, the best one is like, hey, I just heard this new company and they're going, they're doing this. And all of a sudden, it's the early adopters. In the marketing term, as we call them, early adopters. And it's the people who are willing to jump on something brand new. They want to be the first ones in there because they think that it's an opportunity. And then if the company's leadership is not solid, it's probably the best word to use, they're not going to be able to navigate when something, as you said, gets weird.
Yes.
Because they don't have data that this company has been able to go through before. We can go back So maybe we can go back 30 plus years and with Van Dyke alone. And there's other companies too. They can go back and look at how they've done historically when things have gotten, a little shaky. And newer companies, that may be a struggle. I wouldn't know for sure, but this kind of reaction to just laying off your staff because you weren't prepared.
Yeah, it's a lot of risk.
It's a lot.
It's a lot of risk.
Yeah.
All right, let's see what else we got. All right. There's a lender out there that is now leasing space in Walmart to assist with mortgages in Walmart. Gabriela, what do you think?
I gotta be honest with you. I've been to Walmart where you can go in, you can get your haircut, you can get your nails done, you can get your eyes checked, you can pick up your prescriptions. It's Walmart is the one-stop shop for all your consumer needs. However,
Continue.
when it comes to the home buying process and mortgages, the opportunity that exists for Walmart here is that they already have a consumer base.
Yes.
I've gone into a Walmart, but does that mean that I would be someone that would consider getting a mortgage through Walmart? Probably not. Because they're just getting into it. They're getting new. It's almost like comparing, like, if Amazon were to decide to open up a mortgage division. Like, yes, a lot of people buy things from Amazon, but that doesn't mean that it is their niche. So how much resources are they going to actually invest?
Sure. This one's a little bit different
because
it's not going to be actually Walmart doing the mortgages. It's going to be a mortgage company that's already out there that's just leasing space in there. It's almost like leasing office space. But I like your point that it's like, hey, these are one-stop shops that you're probably doing like, once a week or once every couple of weeks. Like, you're trying to do all these things all at the same time. A mortgage is not the one-stop shop department.
It's not.
That's the once every 6 months, once a year, you're kind of revisiting. But it makes sense. I mean, I'm not sure how much they're paying for this lease, but hey, if they're able to get
they will.
a couple buyers a day, they're able to assist and at least, I mean, from my opinion, advise people. You can be able to get people come in and advise them correctly, because a lot of times they need the mortgage originator's advice, but people are always scared of mortgage originators because they think, oh, my credit may be too low. I mean, I have enough assets in the thing. They get really scared about the whole mortgage person, and so they may not call. But if you're already there and they're just walking by you because they're in Walmart, now it could be a confident thing. Like, I always wanted to ask this question. You just drop right in. They ask the question, potentially do a mortgage application. We'll see how it goes. But I did see something great that was crazy about this. You think Walmart, and sometimes people think, maybe not as high credit scores, not as high income, etc. Average credit at Walmart for buyers were 680.
680. I mean, you got to give it to like your Walmart, Costco's, and all these places that they try to make products as affordable as much as possible.
Yeah.
But will the consumer understand that this is a very niche service that's being offered in Walmart, as opposed to what we consider ourselves to be like local lenders. We have an office and we're in 45 states now.
A lot.
Yeah, we're in a lot of states. But a lot of times, our clients have never met us. They've never come into the office. We're doing the whole transactions over the phone, through our portal, and I think I'm going to reserve some more feedback on this.
You got it. We'll see how it goes.
Yeah,
we'll see how it goes. Give it 6 months a year.
Let's put a pin on this one and come back and see what's happening in the next 6 months.
Got it. What else we got there? All right. Share of purchase homes bought by investors is only increasing. And I had a chart for this one. I didn't put it up there, but I mean, 2000, it was showing like maybe 5%, around 2010, 12, 13, 14. It was maybe about 10% or so. Now it's at 25% of homes that are being purchased by some sort of investor. This could be institutional investors. It could be like the big companies like Blackstones that are buying thousands and thousands of homes. It could be like your Joe Schmo next door neighbor
Yeah.
who's buying investment property, but a majority of the homes being bought by investors. How do you go?
They're not wrong. I mean, this is kind of going back to like when you see an opportunity, even in a difficult market, there's always opportunities. And investors are obviously, setting up those companies that we were just talking about, with some capital to purchase homes, but they're not big companies. They could be big companies, they could be small companies, but this is where now I'm going to bring it back to the consumer side of it, like, the first time home buyers, or, they outgrew their first home and now they're expanding, and, it's becoming difficult to get priced out by an investor. I'll share my own personal story. When the market crashed in 2008, my husband and I were like, actually now is a good time to buy a home. Homes are going to they're affordable within our range. We went to 5 homes. We put in at 4 offers, 4 different properties. Every single one we got outbid by an investor. 4 out of 5. And the only reason why the 5th one we didn't pursue it any further was just not in the area we were looking for at that time. So when I look at investors, I'm like, I went back because this is what you do when you're like, I really wanted that home. I wonder what it's going for now. One was like an $80,000 purchase price. We offered 85, and this is weird small numbers back in 2007, 2008, and they had it listed for 150. And I was like, all they came in is they bought the home, they fixed it up, something we would have probably done, and now they're making money. So I can't fault them.
Yeah.
I just think that this is where right now, when we're talking about a listing agent has one home and they're getting multiple offers within an hour's time, and is the listing agent, is their client going to look at an investor offer because it might be a little bit stronger, or are they going to look at some of the other offers, who have actually, verified pre-approval, actual legitimate pre-approval. So I think I just like to see more numbers, to be honest with you.
Sure. Yeah, this is a very hot topic. For me, my first question is this a trend that continues and more investors keep on getting into it, is a trend discontinues? And just looking at mortgage products that are out there, you have your normal conventional FHA, VA, USDA, so your normal, types of products.
Yeah.
And then you have your portfolio products, which are products that are not governed at a high level, but are kind of dictated from bank to bank on how they want to do those portfolio products, which means that they're not going to sell those loans anywhere. Most likely, when they fund the loan, that bank is going to end up servicing it as well, because there's not a market for selling those types of loans. But when it comes to the investor, there's a lot of investor products out there that investors are using. That these are kind of the more shakier loans. So if someone's trying to buy a house, as a primary residence, a secondary home, things of that nature, they have to, for majority of the time, put equity into the home before they're able to have a down payment, things of that nature. They also look at debt to income ratio. They look at a lot of different factors. With many of these investor products, as long as the home is coming in at a certain appraised value, the investor can make the property, without any other income documentation. It's normally been like, hey, as long as the rent schedule comes in, $1 higher, and you get the property. But I even heard of one recently that said it comes at 75%. As long as meaning like, mortgage on the home can be $2,000, rent comes in on the appraisal at 2001 projected, that you can be able to get 2001 for rent. Now they're saying 75% of that. So it's one of those types of products and one of those types of things. A lot of people are doing it, and there's not a ton of foreclosures out there when it comes to these things. But if we go into a recession, 6 months, a year, etc., these investors who are potentially over leveraged, and it's also really putting a lot of index on like the rental markets will continue to increase, which is something that I'm fighting against. Something that I'm trying to, like, how do I reverse it to get people to where they're not renting, they're having some sort of home, even if it's not a single family. It's going to be a condo. It's going to be a manufactured property. Whatever we can do to get you as a homeowner to where you're not paying someone else for the next 60 years.
Yeah.
It'll be interesting to see how that plays out, but that number being 25%, one in every 4 homes being sold right now is for an investor.
Yeah.
That's an interesting number.
Yeah, and we're looking at this number from a national point of view, or
Yes.
okay, yeah, and so I think Florida probably has, we're a hot state, we're a hot market, so there's a lot of investors in the state of Florida. So your concern, it's very valid, but there's also getting somebody out of a rental and to put them into a home. I think I go back to the fundamentals when it comes to this. It's like your first home, or when you are buying a home after you've been renting, you can just live in that for just so many years, and then when you're ready to move to something else. If you're already renting now, you've been renting for 3 years, 5 years, 10 years, it's a long time to rent, to pay somebody else. But then you invest in yourself for 5 years.
Yeah.
And hold that property, and then move at that point. So this is where the as far as like the consumer goes, and they're getting stuck in these rentals where they're going up. It's hard. I think it's very difficult to see that happening because these are members of our community.
Yeah. It's a tough game. It's a tough game because it's really hard to sell a seller when an investor's coming in $25,000 over asking price to go with your new family that's coming in. Some of them have a heart for it. The majority of people, it's like they're like, what can I do with that extra $25,000?
Yeah. Also something to consider is that there are companies as well that are looking to help renters in that case. There's even companies that we have a reputation from the Easy Knock who for people who are trying to sell their home, and they kind of feel like the rental program. I don't have all the details, so I won't go too far into it. So there are solutions, but this kind of goes back to like, who do you trust to help you provide those solutions? And that's hopefully what we're trying to do as in the lending profession.
Yes.
Yeah. And the more education that goes out there, the better that we can help.
You were correct. More education. Got to make it happen. Let's see what we got. Price appreciation. People are like, hey, real estate is in a price appreciation bubble. That's what a lot of buyers are saying. Maybe real estate agents making that as well. On the mortgage side, we're not seeing it right now. And this is not me. This is not my expertise. But the experts are saying they're not seeing that it's a bubble that's going to pop because so many people own their homes free and clear. So many people have 20, 30, 40% equity in their homes. Home values hardly ever decrease. But even if they were to decrease some, there's enough equity in these properties for people to where it's not going to absolutely destroy them. But yeah, this stats is showing that over the past 12 months, they were raising. It started off around 10% appreciation. It started kicking up to almost 20% appreciation in some markets. It's not appreciating. That number's not going up any higher, but it is staying around 18, 19, 20% for home appreciation right now. Gabriela, what do you think about that? And appreciation means when a home goes up in value.
Yeah, the value of the home. It kind of just falls in line with what we've been seeing. These are stats, these are valid. All I can say right now is that, besides when we can go back to a time when the price did go down, there's a lot of things put in place, by the government, to help regulate lending practices. So, they've learned, is what I've learned. And I believe is that the government has kind of learned how to set up more systems in place to help prevent that from happening. Because, that was, in our time, that's probably one of the biggest recessions that we experienced during the market crash of 2008. But to see it now and the appreciation value of the homes, I mean, there were homes that people were buying at an exorbitant amount of price, and then when the market, took a dive, half the value just wiped away.
Yeah.
And that had a severe impact on the economy. So, from a federal, and government standpoint, you don't want that to happen again. So you're going to do whatever is possible and the trends are showing it. I mean, at least in the last 12 months. So when people are thinking, oh, it's going to happen again, I was like, but it's, it really not. We can't make those same mistakes again.
Sure. I agree with you. Put a lot of things in place to where your average consumer buying a home, primary and secondary, is not going to make those mistakes again. But it is a tough stat to me, going back to that one previous slide, 25% are investors.
Yeah.
And the investor products are the ones that allow people to be able to kind of over leverage themselves with buying a home. There's a chart that shows home appreciation average over time. And, let's say if it was around 4 or 5%, around 04, 05, 06, it was going way above that line. Then it dropped down from a historical perspective. And over the past couple of years, homes have run value very quickly, maybe 10 to 15%, but it got us back to that line. But over the past 6 months or so, now we're getting back above that historical average line. If you talk to anybody who's an economist, you normally don't want to see appreciation in industries to be going up astronomically in an industry. You don't want to see national average appreciation going up, causes inflation. You don't want to be able to see, oil prices inflating at a certain amount. You don't want to be able to see home prices. You want to see appreciation, which it normally appreciates, but having 15 to 20% appreciation over multiple years could show there is some weakness somewhere in that market, and I'm seeing it more on the investor side, in my opinion. But go ahead.
I actually agree. And as you were discussing and making some of those points, and I think we're telling a story here because we're talking about now we're talking about the appreciation levels of the home, and if we were to take a chart and compare the appreciation levels as well as the investor purchase, and see the same trend, we might actually be looking at overlapping trends possibly. I mean, it would really be interesting to see in a chart like that, where we're talking about the appreciation as well as the investor purchases, because then we're going to go back a few slides and discuss, the new investor companies, whether it's, your neighbor maybe buying a couple properties, because they're going to refi, get some cash out, and they can go and purchase another home. And then you have these, growing companies or even bigger investor companies as well who are coming in with this capital. And then you showed me this, they were talking about the slide about the company that laid off 46% of its labor force as well, but all of this is everything is a cause and effect. It's a cause and effect. If we're seeing appreciation levels rising for the owner, this is great, because you can do a cash out refi and build some, tear some debts, maybe even buy another home. But now you're becoming an investor as well. Now you're in that trend as well. Then you go back to the investor side of it, who saw opportunity already, when the pandemic kind of started. I mean, because all of these, so we're kind of going back into the early pandemic into the height of the pandemic. So we're talking about, 2021, kind of, I think that's like big height of when the pandemic was really taking place. But that's when we were also seeing, a lot of purchases starting to come in. People working remotely, people moving to other places because they didn't have to get, work in their, their community anymore, commute an hour. So there's all these factors that are now, we're starting to see a trend because we now have months of data to compare it to. We couldn't have foreseen that in March of 20, when we went into our first lockdown, that, real estate almost seemed like it was kind of like a halt. Everybody got paralyzed. Like, what's going to happen? What are we going to do? But then shortly after that, people started finding ways like, no, I still need to buy a home. I still need to sell my home. So realtors were the workforce that made that happen. They were out there talking to their clients, getting them, to convince them or to at least show them the
Thank you, Realtors, for your
opportunity.
service, by the way.
Realtors,
Especially
realtors,
in this
this
market
is
right
a
now on the
shout
buyer
out to
side.
you guys because
Buyer side real estate agents, thank you.
and even when you're representing the listing side as well, you have to have that conversation, like, from the lending standpoint, like, why are you looking to purchase or why are you looking to refi? And your realtors are looking at it from like, why are you looking to sell your home? Why are you looking to buy a home as well? And so we kind of work like parallels with realtors and then their market trends as well. But I think the factor that we're seeing here now is the investor market.
That's the one.
That is really we're going to see more data come out from that.
Yeah. I saw, it's not on here, but all these mortgage companies had their initial public offerings, like, a few years ago, these decent sized, big sized mortgage companies, and now they're down 36%, as a whole right now. So that is a part of the market that could be potentially very over leveraged. Are those people coming in, trying to buy houses quickly, trying to play that flip game, while you have the, Blackstones and other investors of the world who understand how to make real wealth, which is you buy a property and you hold that property for years and years and years and years and years. But we'll see how it goes.
Kind of Warren Buffett a little bit, he still has his original home. I've read. He is. I will definitely say that he's a smart guy, and I think sometimes when you buy a house for whatever reason you want, but simplicity sometimes in just having a home, sometimes that means more to somebody than a bigger home.
Yeah. People also don't know, like, if you buy a home, like, and you get that home paid off, and now you have an additional $2K a month, or with the mortgage payment might have been, that's now just free income towards you. You could potentially save up, 6 months, a year, 2 years, and now you do an addition to that property. Or you get a home equity line of credit to use to be able to do an addition, things of that nature, and now you increase the value even more just by increasing the square footage. There's many things you can do with a home.
Financial planning for retirement. I do have heart for when I see those commercials when empty nesters like, well, my kids are grown now, and this is what I really wanted to do, and the financial advisor looks at opportunities in portfolio and how to make their dreams come true. So I just had to add that in there because I just felt like right now when we're so caught up in the buying and maintaining our homes and upgrading them, whatever we needed to keep those homes going. Insurance, we haven't even talked about insurance at this point. The state of Florida, there's been a lot of changes with that. But there's definitely opportunities at every stage of a person's life. And if owning a home is that leverage piece.
You got it. All right, we can skip that. Self-employment, really tough to get. They dropped the requirement for no more P&L statements. Makes it a little bit easier, but I mean, it's still tough being self-employed. It's tax return season right now, so definitely before you finish filing, once you get a draft copy from your accountant who prepares your taxes, if you have any plans to potentially buy a home in that year, whether it's now, 6 months, 8 months from now, get that draft copy over to the lender right now, so we can be able to see if you're making enough money for whatever real estate plan you want to do.
Yeah. And what I want to say, P&L for anybody who's watching, it's a profit and loss statement, for small businesses. And yes, we do have products that that we can leverage into self-employed bars as well. But this is right, before tax season is finally over. Something from the processing and the transaction side is, we're going to need your tax documents for a lot of products. So usually the last two, and there was a past the cutoff where we could only use your taxes from 2019 and 2020. Now, depending on the loan product, we will need your 2020 and your 2021 taxes. And so if you haven't filed your 2021 taxes, that's going to be a big component of also getting pre-approved as well. So as you were saying, get those numbers, file as soon as you can, and then if you're looking to make that purchase, within 6 months to a year, start now. Look at where you are now, and
always start now. Whether you're
now.
Self-employed, whether you're not, if you have an inkling of trying to buy a home or refinance within the course of a year, start now.
Because certainly, and I say we, as a company, we can prepare you as this is where you are now. This is step A. And to get to step B, these are a few things that you're going to need to do to get to step B. And whether it's, helping with your credit, whether it's, income, saving money for 6 months, there's a lot of things that, the initial pre-approval, whether you're approved or not, can set you up for the next 6 months to a year.
We're actually about to start running out of battery. Let's see how many more we got.
No, we're doing really well for this.
Yep.
All right.
46% of homes selling over list price. It is what it is. We touched on this topic a little bit earlier, but it's happening. Just understand that, and this is not just. There's not a lot of foreclosed homes on the market, less than 1% are foreclosed short sales, but even those are over list price. So just understand that you may be coming in over list price, but when it comes down to it, monthly payment wise, it's probably not going to be a big of a difference. If you're coming over 5-10K over list price, around 300K, you may be looking at a difference of $15-20 a month. So don't get too crazy about that. If you're going to go 5-10K over to be able to win the deal, it could be worth it just as long as you can be able to make sure that the appraisal will come in where you want to come in at. Anything on this?
I do. I actually would only mention one thing is that, we're talking to realtors on a daily basis. We even have a mastermind call on a Friday mornings at, from 8:30 to 9, where, John and some of our other loan officers, loan originators, they're hearing realtors' concerns. They're hearing their scenarios. They're hearing their challenges with their buyers, and maybe even sometimes their sellers are having as well. And they're coming to the lending experts for advice, how to help guide. So as John is saying, when we're talking to realtors, from a loan officer perspective, this is what they're generally saying.
Yeah.
This is true in this market.
And it's not just Tampa, it's not just Florida, it's across the entire nation. Yeah. What else we got? Anything else?
Yeah.
Zillow inventory levels at 729K for February, which is down 25% from 2021 and down 48% from 2020. When it comes down to it, and it's not because sellers are not putting homes in the market. Sellers are still putting homes in the market. They're just getting sold quicker and quicker every single year. Anything on that?
No, I think it's just following the trends. I don't have much to add on this one.
Hey.
You covered it. There's nothing else to add.
You got it, no problem. Tax season, once again, self-employed, get those documents to us before they're fully filed when it's on the draft. And if you're someone who's a first-time buyer, you're not a first-time buyer, but someone who wants to use some of those tax returns, before you get the returns back and you plan to buy a home, speak with your lender as soon as possible. We may advise you to use that money to save up for a down payment. That could be best for your situation. We could advise you to be able to use that towards paying down debt. That could be good for your situation. But most important is to come to us first if your plan is to be able to buy a home, so we can best advise you on where to put that money at. All right, what else we got? Hey, there it is. That's it. Probably got 30 seconds left of battery in the computer, so I think we did this great. I appreciate anyone that's listening to this, even now or listening to this in the future. Gabriela, of course, I appreciate you having you on here, providing that additional support, that additional human perspective. is 100% necessary, and I know
Yeah.
people that listen to this are going to appreciate it. Any words to?
Yeah, John, you know, we've done so many different projects and seminars and educational pieces. What I'm really excited about this is that we're just having a conversation about what's already out there, and hopefully it just comes across as genuine and that we do care. My human element and all this stuff, because I'm not a loan officer, loan originator. I'm not on that side where I have to break down numbers. I come from a strong customer service background, so I get the difficult calls. I get the calls from not only the clients, but also our realtors who are our clients as well. And I've heard it all, in almost 3 years that I've been diagnosed cancer and phones being at the front, and also seeing and interacting with realtors. And, we're coming from contribution. We're providing value. And hopefully that's what we'll evolve into.
There it is.
Thank you,
That's
John.
a wrap.
Yeah.
Appreciate everyone's listening to this. Have fun. Have a great rest of your day. And once again, speak with your mortgage or real estate professional if you have any questions about anything that was provided here or in the future.
And contact information is located
right below.
There you go.
Have a great rest of the day, guys.
Thanks, guys.
See you.